Hi. In this session, we are going to talk about timing principles in cost recording and cost reporting with illustrative sample reports. Well, we are familiar with this picture, cost cube, that shows three dimensions of hierarchical structures where we record costs. And it is very important now to understand that costs are recorded to these hierarchical structures, but in regard to timing, for example, not only actual costs are recorded, but for example, estimates and budgets are recorded to these structures in the project management system much earlier than the actual costs will incur. Well, we have referred earlier to projects as future-oriented vehicles. So this is about the future orientation that we are looking for towards the future at the completion of the project by using these estimates where we are going to end up to. And then in regard to estimates and timing in recording them, cost estimates must be continuously updated during the project for project control purposes. So continuous updating of estimates is analogous to recording forthcoming future costs in advance based on the latest and best information available. Well, what kind of costs do we record for reporting purposes? First of all, the project management system is integrated with other systems of the firm, and the information between these systems are shared. For example, committed costs are connected to contracts and orders which are in the firm's procurement system. And actual costs and revenues come from accounting system, which connects to the project management system. And then there are like payments, receivables, debts information that come from financial systems, like from the receivables ledger and payables ledger. So we are recording estimates which has the nature of a forecast, which is updated all the time towards the completion of the project. Then we are recording budgets, which has the nature of being a target. Then we are also recording to project structures committed costs that come from purchase contracts and the firm's procurement system. Then we are recording actual costs. And here it is important to understand that all firms' cost recording of actuals occurs by using the accrual principle. And this means that actual costs are real process-based. So costs incur when the actual real delivery of the product or service has been taken place. So if we, for example, agree that you pay me 10 euros for moving this pen, when I have moved this pen, the cost has occurred according to the accrual principle. And it disconnects the actual costs from the payment or from sending invoices or from other such things. The costs occur when the actual operation takes place. Then, when we receive an invoice, we can say that we record invoice information. But actually, that is not necessarily kind of a legitimate or generally recognized principle of timing. We just get the invoice and we have some information for that, for example, when to pay and so on. But then when we pay, we have cash-based costs, which means that we have the actual payment. Having written these things to be recorded down, we really can recognize that when the costs are incurred and when the payment is paid, there might be a big difference in time. For example, if I deliver the service of moving the pen and the cost occurs, it might be that it takes me a year to send an invoice and I can give payment of terms for another year. So it might be that the payments are taken place only 2 years from when the actual costs occur. So I think that this is important also to understand when we are managing projects which are connected to firms' other systems. So next, I'm going to explain you this by showing an example of a water heater system purchase from a subcontractor. So that is a kind of a sub-project purchase, and the work will be completed and handed over at time 0. So time 0 is now the time when the actual costs take place based on the accrual principle when the system is handed over. But already at the point of time -8 months from this time point 0. So when we are planning about the procuring of this system, so we can record, for example, 10,000 euros as estimate to the project management system. -6 months from that point 0, so we are receiving a budgetary bid from some contractor or many contractors, and we are correcting the estimate or adjusting the estimate, and we are now recording 12,500 to the estimate. -5, we are receiving bids based on requests sent out, and we are again recording 12,000 to the estimate field, a kind of adjusted estimate. The point of time -4 months, we are signing the contract with certain contractor that we selected, and the contract price is 11,000 euros. So we are recording 11,000 as committed cost, which is also in our procurement system. So this is what we are committed to. We cannot get rid of any more of paying that and about receiving that delivery. Point of time -3. So we get invoice from the advance payment of 1,000 euros that we have agreed with the supplier, and we pay that immediately. And that is recorded as receivable in the balance sheet. That is receivable for us because we have not been delivered anything yet. but we have paid something, so it is in the balance sheet. So at point of time 0, then the work is completed and the work is received. We take this water heater system from the supplier and accepted it. So then 11,000 euros actualize. And we record that 11,000 to the income statement. And we take this 1,000 from receivable from the balance sheet, and we record 10,000 as payable in balance sheet. So that is a kind of a debt that we have towards the supplier, which has already delivered the whole system. Then time point +1, we get the invoice of the final payment, 10,000. So that is what is left to be paid. And we are recording that to the accounts payable ledger. So +2 months, we have internal acceptance round for the invoice, and maybe the project manager is marking the appropriate project work breakdown, cost codes, and so on to the invoice and so on, and accepting it. +3 months, the invoice can be found in the reporting system, so there are all kinds of reporting cycles and delays. And +4 months, we are paying the invoice. For now, the payment can be seen in cash flow reporting, this 10,000, and we are recording this payable from the balance sheet, back from the balance sheet when we have paid it. So it is not anymore our debt to the contractor. So this example is just to show that when we are looking towards the future in the very beginning of the project, and we are recording estimates, so we can know the costs rather fairly well and rather long time before the actual cost take place. And when the actual cost takes place, when the actual payment is done or the invoice is received, so it might even take a long time. So it's better to report in advance the forthcoming costs as estimates, comparing to budget at the completion of the project, and also be very knowledgeable about what our committed costs are. Now, there are few reports, project cost reports that I want to show you, just as an example. So here is a graph about a 36 months project. And when the reporting takes place, it takes place 12 months from now. And we can see the actual cost and actual income until the 12 months, which is the time now. And they follow rather nicely the budgeted income and budgeted cost. But also we can see the steep curve of committed cost raising in the beginning of the project to a very high position. So these are our purchase orders or contracts that we have made with the suppliers. And in this way, by committing to these costs, we already have almost used all the cost, although the actual costs will incur much later. So we use in this report also the term baseline, which refers to budget. So, but income baseline and cost baseline. So we could also use the word income budget and cost budget. And what cannot be seen here in this picture, which curves are missing, are the updated estimates of income and cost until the end of the project. So it would be important to have the updated estimates about revenues and costs there until the completion of the project, so that we could see the estimated profit at the end of the project and compare it to the budget. To be kind of in the mode of reporting costs in advance. Another report, which is not in a graph format but in table format, similarly now shows the subdivision of the project into top-level work breakdown structure elements. So there is, in a way, there is more information. In the left side of this table form report, there is inception to time now. So we report the difference between the baseline, which is the budget, and the actual cost. But more importantly, in the right side of this report, we have the project total. So we have the original budget until the end of the project, and we have the estimate until the end of the project, and we report the difference of these. And a good practice, of course, is always to compare to the original estimate, or if there has been some changes in budget which have been accepted by the board or someone who is really legitimate to do the changes, so we can compare to the updated budget, which now in this reporting is in the column of budget baseline. But the most important thing now to understand is that we are interested about the situation in the end of the project, and because there might be kind of a different changes in phasing of the costs during the project, the reporting of the inception to time now part is maybe not that interesting. There can be deviations, but the deviations can be averaged out later on. This report, which is a graph form report, just emphasizes the fact that cash flows are different and to be estimated items. And you can see in this report, for example, which shows the cash flows of income and cost, that there is a time lag between the actual or accrual-based costs and accrual-based income. And the planning of the cash flows is rather important. It is an aim of any project that if we are a project supplier firm, we don't finance the customer. So we don't pour in more money, more costs than what we can get from the customer, and the customer shouldn't finance us. So they should be rather much in balance, these revenues and costs, and the terms of payments with the customer should be planned in a way that the customer doesn't finance us or we don't finance the customer. Well, having now talked about the cash flows, we have here a picture which shows two S-curves of cash flows, of how the costs are accumulated in terms of cash flows, I mean payments. And there is this principle that is called fast tracking, that was introduced in very capital-intensive industries doing large projects with the ideal to do the capital binding expensive equipment rather late, so that the capital needs come late, and the savings in interest is also a benefit from doing the costly things in the very late phase of the project. But however, due to risks and uncertainties in any project, an interesting question is that how late can you move the most important and costly and probably the most complex parts of the project with biggest risks that might cause additional expected delays. So can you afford moving from the dotted line curve to the solid line curve and doing the very complex and risky parts of the project very late. So project management is not about just-in-time management, and it doesn't necessarily this just-in-time thinking apply to projects, but rather due to significant risks and uncertainties in any project, there must be time buffers, budget contingencies in place for coping with the upcoming risks and complexities. Thank you very much for participating in this session. See you later. Thank you very much.